Hello and welcome to the latest edition of LiveSquawk's Market Talk, our preview show ahead of data and generally central bank uh, matters. Today we'll preview the February inflation report from the Bureau of Labour Statistics. Helping me to make sense of this and the upcoming Bank of Canada interest rate decision is Sam Cutler, Portfolio Manager at 333 Capital. I will bring Sam in shortly. For those of you new to our shows, LiveSquawk is a financial market audio news service. Check us out at livesquawk.com and see if we can help steer you through the headlines. And then one last thing, one piece of housekeeping to do. Just a quick disclaimer, the content provided on this channel is for the informational and educational purposes only. Neither my guests nor I are licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. LiveSquawk is not responsible for any losses or gains that may result from following the content on this channel. And with that, let's get into it. Hello, Sam. How are you?
Hey, Harry. I'm good. Thanks for having me on again.
No, it's always a pleasure. Always very informative. We're looking today at the US CPI report, the inflation report, that's due up in just under an hour's time now. For anyone on this side of the Atlantic, obviously clocks have gone forward in North America, and therefore there's only a 4-hour time distance. So whereas we normally get them at 1:30 GMT, they're at 12:30 now. So yeah, make sure you're well aware of that if you're there to trade the data. Getting into the reads then, I want to take a quick look at the preview. We've written a preview. It's on the LiveSquawk website. It's livesquawk.com. You can get a freebie of the US CPI report. Again, for today's report, we're looking. You can go to the website to get the preview. Quick look at what some of the analysts are saying out here. The headline rate, we're looking for a 2.9% annual read, which would take it down a tenth from 3% last. For the core rate, we're looking at 3.2%, again down a tenth from 3.3. Barclays said it forecasts a 0.3% month over month rise to that, which would reflect a 2.9% annual read. Increase for headline CPI. They say with elevated food inflation partly offset by flattening energy prices, core CPI inflation is expected to slow 14 basis points in February to 0.31 month over month and 2.9% year over year, following January's 0.45% month over month beginning of the year price jump. Even after folding in a fairly broad-based deceleration of core goods and services, price increases should remain elevated, with recent indicators pointing to somewhat stronger gains in used car prices and airfares than we had thought in the aftermath of January's report. And with that, I want to bring in Sam. So, Sam, today's report, I mean, we were discussing this before, I think yesterday, and you're placing a little bit of extra importance on this month's reading.
Yeah, I am, and I'm placing more of an importance on this, mainly just from a microstructure standpoint in the market, right? Not to say that this report is going to be very important for the macro picture, but with the recent events of since, let's call it March 4th, that's unfolded, some of the factor shocks we've seen in the markets. I think from a microstructure standpoint, this report is going to have pretty big implications on the short-term movement in risk assets, and we'll get into why I believe that in a little bit. But first, let's kind of talk about the inflation report and the inflation basket, right? So last month, I remember we spoke, and I mentioned that I still hold this opinion that we're going to get a much cleaner read on inflation in the second half of this year, right? So we're still in that period up until April where seasonal adjustments and the rebalancing of CPI basket weights from the BLS kind of can skew the data a little bit, and I still think we're going to have some feed through from the LA wildfires for the distortions, right? And the BLS recently said that they are increasing the importance of goods relative to services. And we've seen that goods disinflation kind of stall and turn up. If you remember from last month, it still isn't anything substantial, but with tariffs coming into play now, that could amplify goods inflation in the near term. So I
But
think the
yes,
big
it was already we'd already seen it start to, and that had been the softer part of the inflation dynamic, and like you say, that we stopped seeing that sort of soften and just started, like you say, nothing too serious, but it's starting to go the wrong way. And so now,
it is.
then, like you say, it's going to amplify that with the trade issues that we have.
Exactly. So then that poses, I think, the big question is whether the weaker services spending we're going to get at the gross lows is going to outweigh the higher goods prices, right? And if we look at last week's data, we got the ISM surveys, right? And they didn't really paint the best picture on this front, right? If you look at the prices paid component for manufacturing, that came in at a huge jump at 62.4 versus the expectation of 57. 56 was the expectation for that. And then
Right.
the services prices paid came in at 62.6 versus the expectation of 60, right? Now, again, this is a survey, so this could very well, just really be incorporating some of those fears from tariffs. But, we'll come to find that out soon. And like I said, this market still seems to be, kangarooing along
Yeah.
with these tariffs, right? One day they're on, the next day they off. One day it's 50%, next day it's 20%, right? Like the aluminum tariffs and steel tariffs just went into effect at 25%, but then Trump backed down on the 50% from Canada. So it's just something very, very hard to forecast the implications. And I think we're just in kind of wait and see. And that you can see that is weighing on investor confidence, right? You look at the NFIB small business optimism indexes, right? The uncertainty levels are extremely, extremely high. But all that being aside, into this inflation report, I think, the forecasts are pretty spot on. I could see month over month at, 27 bips unrounded for the headline, which would be a fairly decent retrace from last month's 47 bips. And if that does come in line, that would bring the year over year rate down to 2.9 from 3%. Core unrounded could come in at 25 bips, which again would be a decent drop from the 45 bips prior, and that would bring year over year down to 3.2 versus the 3.3. I think, like you mentioned before, some of the key standouts are going to be energy costs. We did see gasoline prices fall, but electricity prices did rise significantly in the Northeast region because we did have quite a cold front move in here, so that could kind of buy you that headline there a little bit. Food at home has room to go lower, and it still feels so funny saying this, but egg prices came down. So the food at home headline could come down a little bit.
Well, you see, sorry, just the egg
Yeah.
prices. People don't understand, probably don't realize how, as an ingredient, how much the eggs are used in a number of food products. Anyway, and it's a baseline cost for a lot of food production. So it's not incidental, I don't think, and it's something that is being flagged for a reason, I guess.
Oh, absolutely, absolutely. It's just a funny thing to hear, right? You see it in Twitter and everyone talking about eggs, and the memes going around. It's quite entertaining.
We got to find some fun somewhere.
Exactly, right? It's a tough market as it is.
Yeah.
But I remember, again, last month we also spoke about the used car prices, and I thought we were going to see a pretty big jump in that, which did come to fruition because of, I think, some of the LA wildfires had some effect on that. But I think on this print, we're actually going to get a little give back on that. So that could help the core goods number. Used car prices, if you look at alternative data sources, they're only seen rising about 0.5% this month versus the 2.2% prior. And new car prices actually fell about 0.1% versus their flat reading last month. Another part to this, apparel and home furnishings. Tough one to judge here, but I do think there's some room for upside just with the looming tariffs. It makes sense to see consumers kind of front load couple of these purchases here. And then airfares. I think based on some of the earnings comments we've had from airlines that we can kind of expect lower price gains in this area. Their guidance hasn't been great. The commentary hasn't been great out of that. Some of the surveys too are indicating very low travel plans amongst consumers. So I think there's some room for downside there as well. Owner's equivalent rent, obviously a big component. I think that's going to stay pretty steady, but there's still some upside risk there from those LA wildfires. I mean, that can take some time to bleed through into the numbers. So I think there's some risk there. If we look towards inflation markets here, they seem to kind of support the forecast, right? The one-year inflation swap has been on a relatively solid downtrend. As you can see, it's kind of the blue line in the chart there since the middle of February. So the market isn't really showing any big inflation fears. Right, so everything's pretty stable. And if we look to swap pricing for this meeting, if you look at the inflation swap curve here for February, swaps are pricing year-over-year headline right at 2.89. So pretty much right in line with consensus, right? So if we move on to the asset reaction here, which is what I was talking about, the importance here of the CPI print, it's going to be tricky, but I want to break down kind of the micro structure here because, I truly believe markets are very reflexive, and the micro is determined by a lot of shorter term flows, how dealers warehouse client risks, the volatility complex. It's very, very dominant in these little intraday moves. And with everything that has happened in the factor world and this kind of degrossing rotation that has taken place, I think there's some really, really key elements here that are very important to understand, right? So the S&P is down 8-9% off its highs. So again, in the big picture, that's not that much.
I was going to say, it's not. We've had incremental rises out of the indices, US particular indices, now for a number of years. So is some of this wrapped up into a natural pullback now? We've seen the effervescent markets, and maybe you want to sell at the top. You want to, maybe we haven't. I'm not calling the top, but you want to start taking a bit of profit out of the market here, and maybe that initial buzz around Trump's re-election, it just subsides a bit now, and you're starting to see people just take a little bit out off the table. Would that be a part in this as well, or is this uncertainty?
I definitely think so. I think if even if you're coming in as a long-term investor right now, what's the view? It's very hard to forecast what this policy is going to be because every day certain things change. So I think there's a lot of degrossing of legacy longs, we'll call it, right? Everyone that's been in these positions, you're still well in the money even after an 8% pullback if you've been invested for the past couple of years. So I think you're seeing a lot of just degrossing from a lot of investors, right? And this comes in to a little bit that factors into the microstructure, right? Because if we're looking at implied volatility, if you look at S&P at the money forward implied volatility at the start of this week, they were placing the most importance on today's CPI print. Vol for today was priced at a little over 6%. Now, just to put that into a little bit of perspective, the March 19th FOMC meeting is sitting under just 4%, and the next employment report is just over 2%. So there's a lot of implied vol sitting on today's CPI meeting. And now if you go look at the VIX curve, right, it's extremely inverted. And if you look at the 1 month VIX future versus the 3 month VIX future, that ratio is sitting at 1.13. Now, we've only seen this extreme 2 other times in the past 5 years. And these inversions, they typically mark inflection points in the market. Right, and like kind of these dead cat bounces, which are just kind of a byproduct of everyone being hedged and dealers short S&P futures to cover those short puts that they have, and that's kind of when you get that compression of volatility, you get what's known as that Vanna bid in the market. So that kind of creates this reflexivity here, and I think this couples in with there's been a huge factor unwind, right? Yes, we've seen the momentum factor completely hit, but the growth value factor rotation has been astronomical, right? I put a little chart up there of the factors. So if you look at it just year to date, right, you see growth factor is down 5.13% this year, while value's up 5.51. After yesterday, it's even more, right? Growth is down 5.73% and value's up 6.57%. So it's been a huge rotation, and this has caused a spike in S&P correlations. The 1 month and 3 month are now each trading in the 99th percentile. And you can kind of see in this chart how 3 month correlations move hand in hand with spot prices. Spot prices in
So
the blue line.
sorry, just to break it down for our listeners and the viewers rather. So we're looking at the white line versus the blue line. The SPX 3 month over the SPX index that you see there on the blue line. Right.
Yes, and the SPX, the blue line is inverted. So when it's pointing up, that's prices moving lower. So as we see correlations spike, we see spot prices move lower. Now I think this is in part due to the huge dispersion trade that's run by the pod shops, right? That's been a really big winner in the past couple of years as index concentration has grown. With the dispersion trade, you're short index vol, long single equity vol, right? So when correlations start to spike, that hurts the trade. So I think that has caused part of this big factor unwind as well. And we've heard some rumors going around that some of these large pod shops they're hit pretty hard this year. Some are down pretty significantly, and there's even been news reports out of a couple index rebalancing pods kind of blowing out and getting fired on these factor shocks. So I think that also segues us into the next part from all these systematic strategies, right? So from here, CTA selling flow should kind of start to subside unless we see a very large vol spike happen. Dealers are extremely short gamma, but as the market has moved lower, their Vega supply has been reduced. So they're really not needing to sell too much here. If we look at the numbers, vol control funds have sold $15 billion worth of stock on Monday and $43.5 billion in the past month. These leverage ETFs have sold $16.5 billion on Monday and $52 billion in the past month.
So huge. We're talking. This is a fundamental shift is probably putting too much on it, but these are huge shifts that we're seeing in positioning and just market activity.
Exactly, it's been just insane sell side flows, and it's been calm, right? You haven't seen panic, you haven't seen capitulation in the market, right? It's been very just controlled selling, and I think that is exactly what kind of Trump and Besson have hinted at, right? They want to slow growth a little bit, and they kind of want equity prices lower because that's going to cause rates to move lower, and it's going to kind of force the Fed's hand to lower overnight rates here.
I want to look into that a little bit. So yesterday we heard from President Trump, and he came out and said, "Look, you have to expect some disruption. What we're doing is monumental. We're trying to create a better America. We're trying to create more jobs, American-made jobs, and this needs a bit of disruption." He mentioned, I think he mentioned lower rates, and he said, "Look, you're going to break a few eggs to get there." So and this trope that Trump only feels good when markets are going up is too simplistic. It's always been too simplistic. People like to. I don't take sides. I'm apolitical when it comes to this, but people take pot shots and just think he's a very linear character. But if he may well be, but he has clever people around him. And do you think this is a manufactured move that we've seen from them, a narrative that they're bringing out right now?
I think it is. I'm a little confused on that point, as I don't know if they've made it clear they want to slow growth, right? So I guess you have to look at it from an investor standpoint. If you're sitting there and you're sitting on some good mark-to-market gains, right? And Paul, and they're pretty much telling you they want equity markets lower. What are you going to do?
Well, you don't buy it.
You're not going to buy, right? You're going to want to start degrossing some of your positions, or if you're necessarily not buying their rhetoric, right? You think
Mm.
Trump's going to cave, you think the S&P is going to go down 15%, and all of a sudden everyone's going to freak out. He's with ahead of midterms. Before midterms come up, people are going to start panicking. He's going to be afraid, and they're going to do something to reverse this, right? If that's your case, then what do? You reach for maybe downside protection. You maybe deleverage a little bit. You reach for some downside protection, which I think is what we've kind of seen here with the way volatility's kind of moved, right? Vol, the VIX, put skew has increased quite a bit, and this kind of brings us into everything that I was trying to make a point on the microstructure of the market, right? There's all this uncertainty, so people hedge or they degross, right? So we've seen this take place now. We've seen some of these puts be monetized, right? We have a large concentration of put gamma sitting out there at 5,500, right? So that kind of would mark, kind of that systematic base in the market. Now, with put skew coming down, the good look at that.
Would you just again for those and for my benefit, just explain a bit more about this, the gamma and what that means and what you see from that in terms of looking at the chart now and the way it's flipped over the past on price actions from around, what was that, 50? So I didn't have my glasses on, 5,800 onwards.
From around 58, yeah, it kind of creates air pockets down. So the base premise of monitoring kind of dealer exposure is you have to think how dealers, right, interact with clients, right? And you make some assumptions here. Your average client is long the market, right? And what do? They sell calls against their positions for income, and they buy puts for protection, right? Yeah. So that makes dealers who warehouse risk long call, short puts, right? So when they have a positive gamma, their flows of how they hedge these positions and options will dampen volatility as they sell into rallies and buy into weakness. And then when gamma is negative, it's the opposite, right? They have accelerant flows that create kind of this reflexivity. As the market moves lower, the deltas on their short put are gaining traction, so they have to hedge more, right? And the way you hedge out negative delta in an S&P put is by delta 1 in the futures, right? So if you're short 1,000 delta, you got to be short 10 futures contracts. So as your deltas move around, they buy and sell more futures, right? So this plays into what we've seen now with put skew starting to weaken, right? So as put skew starts to weaken, that signifies that there's not as much reach for downside, right? And that makes sense here because what has happened to those puts, right? They've increased in value. The volatility is realized higher, so it makes reaching for downside much less attractive, right? And you see that in the VVIX as well, which is essentially volatility of volatility, right? That's come off the highs, signaling further there's really no more added reach here for left tail, right? And you have to think about what volatility is here too, right? Volatility is extremely mean reverting, right? And it needs to feed on itself. So with front month VIX futures here, just under the 94 handle, right? This is implying S&P moves of 1.5% a day. So those need to realize in order for volatility to sustain at these levels. If volatility doesn't sustain at these levels, right, and it comes off, this is, again, into the microstructure, what will happen with the futures and how these dealers hedge out these positions, right? As volatility compresses, right? As volatility moves lower, that affects options, right? There's a second order Greek known as Vanna, right? So the compression in volatility will lead to Vanna, right? And that requires, it's kind of the decay of the delta. So then the dealers have to start buying back along with charm there, right? So they start buying back S&P futures. So that's why I was talking at the beginning from a micro standpoint. I think this is a very important print because if the CPI is more or less in line, I think we can see vol come off here, right? And if vol comes off, that's going to lead to kind of this systematic bid in futures, which is going to help drop correlations as well. And I think we could see a little reflexive rally here in the market. Now, I'm
So
not
mechanical. This is we're getting into mechanics here, and for those less averse in options and stuff. But so this could really be a mechanical move post data today that may have very little to do with the macro scene on the whole and those macro trades. And typically, just from my experience in the past as a broker and working at banks don't always react to the number. Some of the big papers, some of the big investors will.
Hey, Harry, I think we lost you there. I think Harry cut out here, guys. So I mean, I'll try to finish off what Harry was saying there. Yes, exactly what I was saying. It's going to be much more of a microstructure reaction to this print than macro, right? So if this does come to fruition and we do see volatility, compress and we get these reflexive flows that cause kind of a short-term bid in equities, I wouldn't necessarily assume that this is the time to turn bullish on the market, right? There's obviously some very cheap optionality bets you can put on right now to play for this reflexive bounce. But I think, that there's so much uncertainty in the market here. And that chart that Harry has up there is the policy uncertainty index, right? And you can see how high it is relative to history from 9/11 to the GFC to COVID to now Trump 2.0. So there's still a lot of risks here, right? So I wouldn't necessarily see this inflation report, if it does come in line, come in a little lower, and think all is right in the world, right? I don't think that the low is in for the market yet. This administration has made it very clear. Sorry, they want to slow growth, right? So this is more very tactical microstructure to play for a reflexive bounce. And, if you're a portfolio manager, it's, a good time to kind of maybe hedge your book into these rallies, right? And prepare for a little more downside. And the main risk, obviously, to this microstructure is that, we just continue to be in a degrowth mode, right? As growth fears and policy uncertainty kind of remain in investors' front of mind, there is a chance that we could see kind of a vol down, but a spot down move as well, right? And vol can still come down and stay moving down, and spot prices can continue to move lower if participants don't reach for more protection and we just kind of continue to bleed out of what we referred to earlier of kind of those legacy longs.
Okay, I think we cut out for a little bit there. My internet line went down a bit, but hopefully people got the gist of that, and we can put some content out there for people afterwards. I want to very quickly, before we finish today, because we've got the numbers in just over half an hour, I want to look at Bank of Canada and just to give a quick overview on what to expect there. So just quickly, Bank of Canada March interest rate decision, expecting a 25 basis point cut to take it from 3% down to 2.75%. A note here from National Bank of Canada says it's likely to make its second monetary policy decision of 2025 on Wednesday. In its most recent meeting in late January, the bank didn't offer any forward guidance. Governor Tiff Macklem arguing that doing so would not be useful in these highly uncertain times. As it stands now, there's a roughly 80% probability discounted that the bank will deliver a 25 basis point cut on Wednesday. Again, it leads to what we've said before, Sam, about the uncertainty in all this. Even up to the point I'm trying to write a preview for the events. You have to keep going back and rewriting it because every hour something else happens, and it's just I gave up in the end. So just quickly on Canada, do you see what are you looking at for Canada, basically?
Yeah, so
It's a broad stroke because I understand there are so many factors in this at the moment.
yeah, I mean, it's the Bank of Canada now, their hands kind of forced, right? Because look, they've cut rates, what, 6 times this year? Or not this year, sorry, since June
But since
24,
then,
since they started their easing cycle. I think that was back in June, right? They've cut rates 6 times, right? So the policy rates dropped from 5% to 3% now. And if you look at data to start the year, right, it hasn't been terrible, right? 2025 data so far has been good. GDP was at 2.6% in Q4 of 24. We've had strong job gains in November and January. February was flat, but reading their statement from January, right, it did seem to show a little bit of balance risks. But like you said, tariffs. Those are the problems here, right? Take this data. Take this data at face value, right? Eliminate tariffs. It supports a pause in my eyes, right? But I think this tariff uncertainty, it just keeps the momentum for easing in place, right? And you can kind of see if you look at the overnight index swaps, right? The kind of implied cut odds for the Bank of Canada in March, right? They were near 100, they were over 100% chance of a cut as this kind of tariff uncertainty came, and they were going to pause the tariffs, right? Blah, 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 whatever. It moved to under 50% chance of pricing for a cut, right? And now tariffs get implemented. They move down. Now we're back to pricing 98.8% chance of a cut, right? So I think this cut is most likely going to be an insurance cut, and they're going to frame it as risk management. And they're going to keep cutting as long as this tariff uncertainty is in place.
But I mean, trying to navigate through these waters. I mean, even you got different the regions, Alberta and Ontario, and they're bringing their own sort of fight to the table in different ways. So it's disparate, and so therefore trying to manage that as a central bank must be an absolute nightmare right now. Like you say, they held back a little bit last month in terms of their rhetoric and left things open, but it really is one of those you're trying to traverse this because it does change almost on a daily basis. As we saw only yesterday with comments from Ontario's Ford as well about suspending some tariffs on some of the US states. So it's one to watch. It'd be interesting to hear the language, I think, from the Governor Tiff Macklem and to see how they really try and toe that line and again, just try and navigate their way through this whole thing. Anyway, as I said, we're encroaching upon prep time ahead of today's CPI read. So again, just to quickly go, and Sam, thank you very much. And it's lovely having you on because you can really get into the reads and just show, just highlight different things that I don't think people would necessarily be aware of when it comes to these numbers and the factors that traders look at in amongst all this. It's not linear, like you say, from the macro side, but there's a micro element as well that has an influence on what happens in the immediate price action. So thank you very much for that.
Always my pleasure.
Thank you very much. Just to quickly recap them. So for today, we're looking for the US CPI report, just to see an easing of 1/10 on the year-over-year rate. Keep an eye on the rounded down numbers, as Sam has pointed out. Keep an eye on the OER as well, because that's going to be, I think, a factor in all this, as we've sort of noted as well. So there are a number of little things. Supercore reading will be important and will be focused upon as well. We'll cover all those points within the reading today. And as I said, within half an hour, I want to try and cut this short now. So again, Sam, thank you. Everyone else listening, thank you for listening. You can listen to this back on a number of different platforms, the Spotify, the Amazon Music, wherever you listen to your podcasts. And check out LiveSquawk.com, see if it's something that can help your trading day. And good luck with today's data and the markets in general.